Now, the next one we'll look at is your butterfly. So these are what we call the wide wing butterfly. So with the wide wing butterfly, we're going to give us a bigger profit zone to work with. So the wider the butterfly, the bigger the profit zone, the easier it is to make profit. So again, I kind of relate that to if you're trying to catch a butterfly, it's going to be easier for a big butterfly net versus a small one. So this is where we can adjust the width of your spread for profit, loss, or risk. So we do that with that butterfly spread width. So again, it's going to be defined risk trades, great for hedging, great for what we call targeted directional swing trades, great for what we call pinning trades, where it goes out a specific strike, great for trading high volatility market, great for trading high price stocks because we can do these trades for very little at risk, very little cost versus if you're just going long calls or puts. Trade duration, it could be 1 day up to 2 weeks is typically the kind of the time frames that we'll look at. Always going to give you positive data, so no time decay. Returns, again, of all the different spreads, this will give you the highest potential return on your risk of any option strategy. So 2 to 1, 10 to 1, or even higher. So let's take a look at a couple examples here. So this was a short trade on SPY, all right, using a wide wing butterfly that was $7 wide or $700 per spread. So this, again, alert trade setup sent out to our members. And so you can see new SPY short trading around 378.91, market below prior day's low by butterfly, the 26th September, 377, 370, 363. Okay, so that was the spread. Now look at the cost. The trade risk was $115. That's your max risk, is the debit paid. Now you can reduce that. You can always get out before it hits your 115 as your max loss. So potential profit, though, on expiration in this trade setup would be $585 or 508% return. So basically, you're risking $1 to theoretically make over $5. So that's what makes it such a great trade strategy for really high extreme market volatility because of the, markets could swing back and forth really fast. So you can keep your risk super low. So here's the trade setup here, the charts, again, using momentum for direction. So we've got a short was set up here on the 21st, momentum negative. So we went with the short trade here. And at that point, it was traded at 378, so shorted there and then got out. A few days later, on the 26th, it was trading out 369. So went down perfectly, and we were able to get out here. Yeah, 115. Yeah, so get out there. Let me back up a second. I should have been 115 at risk. Yes, well, when this was sent out, I put it in the alert at around 110. When it was actually executed, it was 115. Okay, so this is kind of give or take. So when these go out, the markets are moving, so it can change. So this was when it was sent out, it said 110, said around, but actually set it up, it ended up being 115. Okay, so shorted there and covered here when it was down to 369 and did this with the butterfly. So again, targeted the trade. And so the trade, we were targeting that 370 strike right there. This was based on Fibonacci and moving average kind of support resistance. So you can see 377, 370, 363. Now, think about it. If you had just done the ETF and shorted the shares of SPY and it hit your target 370, well, you would have made $8.91 per share. Your return on your capital at risk, though, would have been in this situation 2.35%. But with this trade, doing the butterfly, your risk was only $115. Okay, not the share. If you did the share, it's going to be much greater, and your potential profit in risk reward is going to go, so 700 minus your 115, so theoretical 585. So you could theoretically make 508% return on this versus here, you would have only made 2.35% return. All right, so that's the beauty of just spreads in general, but especially this butterfly kind of combination. So here it was where it went out, wasn't max profit, all that black area is still potential profit, but took the trade off here on the 26th, it was trading out at 369.79, so it was trading right there. So this spread went from 115, now it was out to 355, which was a profit of 240 per spread on your risk of 115. That's a 208% return in 5 days. So you can see there's no comparison as far as risk reward, returns, things like that. So that's just the basics there of a nice wide body butterfly. Now, this was expiration the 26th, and it was just trading right there earlier in the day. At the end of the day, if you'd held it, it was right here, this thing was going to be up to the max profit, because all that black area is still what's component of time and volatility that's still left in the spread.